All right. Okay, welcome to the second session of the 2013 Farmer Borrower Training. A little bit of review now. Those of you that viewed session one, you need to either fax in or email in or send in the mail the information about you on page 28 and 29 in session one, and also from session one, the goals, I think it's page 60. That's information we need to start you out, and that's part of your homework assignment for session one. Session two, then, we had Mr. Bleeker talk about estate planning and business structure and legal issues. He's a lawyer in Mitchell. And then in the afternoon session, which is part of session two, we're going to talk about balance sheets, and we're going to talk about some averages in the annual report. And that was sent to you. You all have a copy of the 3-ring binder and the document, the manual, the paper copy of stuff. So what we're going to do today then, in this session, we're going to go through a sample balance sheet. We're going to go through a sample projected income and expenses for this coming year. And then in session three, we're going to do the financial ratio part of that sample farm. And we need to have all the same numbers so that we can do the calculations together, and then it flows. And then your homework assignment for session three is to find your most recent balance sheet and calculate your financial ratios. So the homework for session two, there is none. This is a review and a building of information for session three. Okay, let's get it started then. If you would go to session two, page 2. That's where we're going to start with balance sheets and cash flows. Okay, hang on a minute now. There we are. Okay, session 2, page 2, and our 3-ring binder is divided up into the 5 sessions. That's the first part of the number. Down on the bottom, session 2, page 2. That's where we're at. You can follow along in your 3-ring binder, and the information is there for you. We're going to do balance sheets and cash flow statements today. And so we got a little bit of theory and information to put together here. A balance sheet is a snapshot of your financial position at a particular time. So on page 3 then, and we're going to zoom a little bit here, give us time to bring this together. That's page 3 of session 2. And what you need to do then is we're going to talk about the different parts of a balance sheet. Most commonly, the left side of the balance sheet is the asset side. The right side is the liability side. And we're divided into 3 different terms of length: current, intermediate, and fixed. So, for a current asset, it's terminology, it can be converted to cash within 1 year. So your feeder cattle, your grain, your cash in the bank, savings accounts are examples. The intermediate would be that has converted to cash in 2 to 5 years. That relates to machinery and breeding livestock. Your fixed assets, 5+ years, basically land and buildings go in that category. And that is likewise with your liabilities. Current liabilities are those that are due within 1 year. Your line of credit. Borrow money to feed out some cattle or hogs. Intermediate is 2 to 5 years, and that would be the loans for machinery and breeding livestock. And your fixed or long-term is land, buildings. So then when we get to the bottom, then we add up our current, intermediate, and fixed assets and gets our total assets. Same way with liabilities. And then here is our mathematical equation. Total assets minus total liabilities equals net worth is one terminology for that, or owner's equity is another terminology. It's what you own, your share of the business. Okay. So then I'd like to have you go into the South Dakota Annual Report. And remember now, that's the averages of 100 farms in eastern South Dakota for the 2011 year. We are working on those individual FinPAC analysis for the individual farms in this January-February time frame. They are then averaged, and we get done with that about the middle of March. They are averaged and printed and published. This is the 2011 annual report, and it was published, distributed in 2012. So we're going to go in this, and we're going to go to page 2. And that's a snapshot of the highlights of the book. And we're going to zoom in, please. All right. And we're going to do a little focusing, because maybe it's not quite... Ooh, baby. There we go. Got it. Okay. In this middle part is critical information. It gives us the net cash operating income, the page number and the line number, but also the dollar amount. So in the year 2011, the average cash operating income was $901,000. The operating expenses was $703,000, and the difference is net cash income of $197,000. And then we have net farm income of $228,000 on page 9. So we take the cash income, which is the income minus the expenses, and then we go into the accrual method of accounting and add into the net cash income the change in inventory of the beginning of the year versus the ending of the year. And then we depreciate the machinery, buildings, vehicles. And so that's why that is the net farm income. So we basically had about $31,000 more inventory than depreciation. Line 5 is the rate of return on assets, 10.4%. Change in net worth of $187,000. So the difference here is the family living costs from the farm. And then a equity to asset ratio. Sweet 16 financial ratios are on page 14, and we're going to go through those next in session 3. Your family living costs is $66,000. The crop information on a per enterprise basis of corn, oats, wheat, soybeans, alfalfa, the livestock, and the financial trends. So if we go to page 11, we're going to look at the balance sheet of this average of the farms. Okay, I'm going to work with the averages. Page 11. All right, you can look at examples of current farm assets. Cash, prepaid expenses, growing crops, accounts receivable, hedge accounts, feed and seed, government loan money, livestock, that's feeding, and other assets. So the average farm had $655,000 of current asset. The intermediate assets would be breeding livestock, machinery and equipment, title vehicles. Other intermediate assets, we had an average of $588,000. And long-term assets being land, buildings, other, $877,000. So the total farm asset on the average farm in eastern South Dakota, $2,120,000 of farm asset. And we come in and add in non-farm, which should be probably the house, the personal vehicles, personal savings accounts, other personal investments. The average farm had total assets, farm and non-farm, $2.3 million. The liability side then, the current liabilities, accrued interest, accounts payable, current notes, the principal portion on term debt, $222,000, intermediates of $257,000, long-term of $273,000. The average farm had farm debt at $752,000 on the average. We had some non-farm liabilities. So the total liability, $778,000 on the average farm. And again, if we do our mathematics of subtracting total assets, which is farm and non-farm, subtract that away from total liabilities, we get a net worth of $1.5 million. And that was $187,000 larger than the previous year. And you divide the gain by the previous year's net worth, and it had a rate of return of 14% on the average gain in net worth for the year 2011. Okay, if we go to page 13 then, we're going to look at the liability structure and go back in time a little bit, the bottom half of that page. This goes back to the year 2005. I can go back to the year 1990. And basically, the trend line has been increasing since 1990. Not as steep as it has the last few years. More of a gradual trend line up. The structure of the assets and liabilities here, that's what we're working on. Long term is the bottom checkered portion. The clear white is the intermediate, and the top portion is current. Has there been a shift in liabilities within the three areas? Probably a little bit more to the intermediate and long term, because the fixed interest rates on intermediate and long-term debt have been low, and the higher interest rates have been on the current or the operating line of credit. So what we're doing is we're shifting more from the current liability portion into the intermediate and terming it out, putting it on a 3 or 5 year plan, and having a fixed rate on that. Fixed rate of interest. If we go to page 53, I want to look at some trended numbers. Okay. These are from the year 2005 to the year 2011. Let me widen this just a smidgen. Okay. We're going to go to total operator equity. And you can see we're going to work with the average now, and you can look at the high and low, but we're going to work with the average. In the year 2005, the average equity on the farm was $820,000. And if we go to the year 2011, we just looked at it, $1,524,000. We almost doubled. Now, we have not doubled the value of the land. Currently, we are on our balance sheet, and we will review that in a few minutes. But basically, on our balance sheets, we are putting down 50% of the true fair market value as our balance sheet value. That's averaging pasture land and tillable acres. And we are following the industry standards by the lenders. All right. Rate of return on farm assets. You can see it's been very healthy the last 4 years. 10.4%. 2010 was an exceptionally good, profitable year on the farm at 15, 10, and 15 again. The operating profit margin ratio is a key one for those of you that are wishing to expand your operation by bringing another family member into the operation. The average is 21, 23, 20, 34, 35, 30% the last year. And that relates to the profit margin on per dollar of gross margin. And I have an example down here. We will talk about this now. We'll talk about this in session 3 because it's an important part as our farm families are getting older and we're trying to figure out ways to bring additional family members into the operation, have a family draw or pay for 2 family livings out of the same operation. So this is the short and quick way of doing it. If I want to pay a family member $40,000 in wages and benefits and salary, and I've got a profit margin ratio of 29.8%, I divide what I want to pay the new employee by that in a decimal form, and that's the amount of dollars of gross revenue that I need to generate to pay for that additional family member. So in this case, if I want to pay $40,000 wages and benefits to a family member to come and bring them into the farming operation, and I have a 30% or 29.8% profit margin ratio, I need to generate $134,000 of additional gross revenue to pay for that individual. You take some time to think on that, and this is what happened in the 80s. We tried to bring in another family member as the farm generated the same dollars of gross revenue, and it didn't work, along with falling land values, but those were the two things. Family living, then, we're on page 52. Average family living costs in 2005 were $40,000, and it's up to $66,000 for this last year. The cash operating income from $476 up to $900, so it basically doubled. Cash operating expenses from $401,000 up to $703,000. And our net profit. Net profit now from $72,000 up to $228,000. That's net farm profit. That includes the cash income for the year of 2011, plus the change in inventory values of feed and livestock, accounts receivable, minus the depreciation. We take basically a 10% standard depreciation on machinery, vehicles, 5% on buildings, consistently over time. So therefore, this is not your income tax net farm income, because some of you have bought assets and depreciated them all out over 1 year. Rate of return on equity. This relates to then, if you sold everything, put your money in the stock market or savings account or any investments, could you get this return on that money, or are you better off leaving that money in the farming operation? That's a very simple answer to that question. Okay, now we're going to do a little bit of switcherooski here. Okay. What we need to do now is to walk you through a sample farm that I have, and we're going to work with the pages in session 2, pages 10 through about 15. We're going to go through this sample farm. I'm going to give you all the details, and we need to proceed through this step so that we have all the same numbers for current assets, intermediate assets, long-term assets, current liabilities, intermediate liabilities, long-term liabilities, and net worth. Then we can go to the next step next session, and that is the financial ratio portion of that work. So, if you would work in it's really the Form 2037, and these are the government forms that you fill out for your loan and the reporting of your assets. And so these are the actual forms that you use, and you give them to the FSA loan officer. He punches it into the computer, and then you have your trends and all that information. So let's go through this sample farm. We're going to work on it here. It's not going to be document. There we are. Okay, so if you dig those forms out and write these numbers in, we'll get that taken care of. All right. We got to do a little bit of a situation here. Okay, we're on page 210, so session 2, page 10. And it is the FSA Form 20 37. So we're going to title this the sample farm, and that's my sample farm. And the year that we do this, and date is 1/1/2013. So on my sample farm then, if you write these in, follow along with me. I'm going to try not to go so fast that we get you lost. I got $1,000 of cash. I've got a savings account for $5,000. And then I've got something called accounts receivable. Joe owes me $4,000. And here we go. This is my January 1 inventory of my grains. So therefore, I've got corn on the farm. I got 12,000 bushels. Now, I believe in your book, this is in session 2, it's about page 16, but it's the recommended prices from FSA over the years, and we go to 2013, and I'll put that on the screen. And it has corn listed as $5.50 for a balance sheet value. Yeah, I know you can go probably somewhere and sell it for $7, $7.25, but this is balance sheet values, which are conservative. So I put it in there at $5.50. I do my math, that comes out to $66,000. All right, the next is I have winter wheat. I got 10,000 bushels of winter wheat in the bin at the elevator somewhere, but it's mine. And on a balance sheet value is $6.50 a bushel. So the mathematical calculation is a good one for us. 10,000 bushels at $6.50 a bushel, that's $65,000. All right, I got some mixed hay. 500 ton is the amount. And I got it priced at $90 a ton. And that amounts to $445,000. I get my price, mixed hay right here. I've got some silage, which is kind of a tough one to price because the quality varies so much. Silage, 100 ton, I price it at $45 a ton, $4,500. Now I got some growing crops, and don't forget about some of those things that you might have as an asset. And if you have a good balance sheet to go by from previous years, then this is a piece of cake. It's very easy. So I got 100 acres of winter wheat that I planted. I calculate that I got $75 per acre in there of seed and fertilizer and maybe some tillage or whatever. So that's $7,500. Now, I've also got some livestock here. Some steers. I got 50 head of those. On January 1, I estimate that they weigh 650 pounds each. And on our price sheet, and you got to watch these prices, my friends. Steers, 650. That's between 600 and 7. That's $1.40 a pound. Now, if you put these on an even 7 or 8 or 9 weights, then you got a variation of which to go for. So don't value them or weight on a 7, 8, 9, or 100 pounds each. $1.40. $45,500. I've got some heifers then, 45 heifers, and I value them weight-wise, an estimate of 625 pounds. So our heifers, between 6 and 7, are $1.35 a pound. Use these values. You're working with FSA, use their values. So 45 head times 625 pounds times $1.35 a pound is $37,969. All right, I got some prepaid expenses. Bring them up. $20,000 of prepaid, whatever it is, you can title it. So I add up all of my current assets and I come up with a value of $301,469. That's the key number. Make sure you have that. So then I work the current side of my liabilities. Well, I got an FSA guaranteed loan. I got a balance there, January 1 now, 2013, of $150,000. And I got a Visa card or Visa something of $10,000. So therefore, on the current side, I have assets of $301,469 of asset. I have current liabilities of $160,000. Okay, if we go to page 2-11, we're going to work with the intermediate and long term. In the intermediate assets, I've got beef cows. I raise them. That's for income tax purposes. You need to separate if those cows are raised or purchased and how the depreciation is handled. I got 100 head of those characters. On paper, I value them at $900, so that's $90,000 value. And that is conservative, but let's be a little bit conservative on this. That way we don't get caught up in the wild rides up and down. I have a value of machinery of $300,000. So then my total intermediate asset is $390,000. I've got buildings under long term now, $100,000 for the buildings, and now comes the land. I separate out crop ground from pasture. Crop ground, I got 800 acres that I own, and I put a value of $2,000 an acre on that, thinking that in southeastern South Dakota the land is probably worth $4,000 conservative value, so I put it as 50%. So I got $1.6 million for my crop ground. Now I have my pasture, 400 acres. And I put $1,000 an acre on pasture, thinking that market value is about $2,000, so that's $400,000. And I got some long-term or co-op equities that I will not collect unless I reach a certain age or pass away. So that's $30,000 of equity. So my total long-term would be the buildings, the crop, the pasture, the equity, $2,130,000 total long-term. Let's go to our intermediate debts. I just listed what I have here on my sample farm. I got JD Credit for $75,000 and an Ag Direct for $25,000. So my total intermediate debt is $100,000. Long-term debt, I just carry a loan on the Farm Credit Services of America on land at $600,000. So now we get into the accumulation of everything, and I'll highlight these numbers again for you to make sure you have them. My total long-term asset, $2,130,000. I got long-term debt of $600,000. So and I like the FSA forms. They have a line number here, 4I, total farm assets. It's from 1U, 3I, and 4H. Right here. There's 4H. There's 3I. I add up my current asset plus my intermediate plus my long-term. I get $2,821,469. I add up my total farm debts of current debt of $160,000 plus my intermediate debt of $100,000 plus my long-term debt of $600,000. I get $860,000. That's correct. So then my assets of $2,821,469 of asset minus my liabilities gives me my net farm equity or net worth of farm only. $1,961,469. And I can do the math down below net worth or owner's equity. Okay, we got a little bit on page 2-12, and this is the non-farm portion. And under stocks and bonds, $20,000. Cash value on life insurance of $10,000. Household goods of $5,000. Personal vehicles, $15,000. And I got a non-farm real estate, which is the house, of $50,000. And for my sample farm, my total personal assets comes up to be $100,000. I still have a house loan on the liability side of the personal. House, $30,000. So now then, on the asset side, I add in the non-farm asset plus the personal asset. I get $2,921,469 of non-farm and farm assets. Do the same thing on liabilities of adding the farm liability plus non-farm. I get $890,000. So my equity, farm and non-farm, is subtracting those two. $2,031,469. Okay, now we got page 2-13. And I want to list my machinery and equipment. Okay, so I can list them each individual, and I will do that. And we got one John Deere tractor. It's a 4440 model in excellent condition. I got the year of 2001 for $80,000. Likewise with the combine, John Deere, a 9600 is the size or model. Excellent condition, a 2004 year, and I value that at $120,000. I've got a sprayer then, I list it there. It's excellent condition, a 2005 model, $50,000. And I got a disc. Has to be a John Deere, of course. Excellent condition, 2006 model for $25,000. And a soil finisher, John Deere. Excellent condition for $25,000. The important concept here, your total value on your machinery. Please close all the loopholes and don't send any red flags up. My total value of machinery on this page should equal the value that I put on my balance sheet. Don't leave any areas that someone can come and attack and say, well, this is not right. Likewise with my personal vehicles. I've got a pickup, a Ford 25 F-250. I value that at $10,000. And a car then at $5,000. So that then equals $15,000, and that goes back to my balance sheet also. Okay, that's our sample farm. You should have that information of what we need. That's your balance sheet as of January 1st of this sample farm 2013. So, part of your homework assignment for session 2 is not to mail or fax or email anything back to us. It's just to find your most recent balance sheet. And then in session 3, we're going to do the financial ratios on our sample farm. And your homework assignment for session 3 is to complete those financial ratios. We'll talk about that in session 3. Okay, so then we're going to go back to this sample farm and do our projections of income and expenses for this coming year. We're going to walk you through this step at a time. This is page 2-14. Now you have that in your manual. And we had this session in Mitchell, and it was discovered that in the copying process, you do not have the second page of this. I will email that to you. All right, our first page, and here we go. Remember what we're working with now. We're working with the FSA Form 20-38. And it is the projected income and expenses. So we did the actual balance sheet. Now we're going to project the coming year's income and expense. Sample farm. 1-1 for 2013 is the beginning of the time period through 12/31 of 13. Projected, right there. Okay, here we go. This is what you intend to plant and harvest. So therefore, let it be known that I am going to, and I got to widen this a bit because I'm running out of room. Okay. We're going to plant 400 acres of corn. And you can write this down, copy it down, follow along with us. We anticipate 125 bushel an acre. Maybe that's our crop insurance guarantee. Maybe that's our normal yields under normal conditions. 100% of that is ours. In other words, no share crop rent. We're going to use 20% of those bushels to feed our cattle. So you do the math. 400 acres times 125 is about 50,000 bushels. So therefore, I'm going to be able to sell 40,000 under 1J. I anticipate sales to be $5.50, and that comes from that good old page, you know, right here. Now, maybe I contracted some and did whatever, and maybe I can shoot this up to 6.5. That's up to your call. So therefore, that many bushels at 5.5 is $220,000. My soybeans, 300 acres. I anticipate a yield of 35 bushels an acre. It's all for sale, none to feed. So I got 10,500 expected bushels. $12 a bushel, $126,000. I got some winter wheat, right? We got it planted, 100 acres. There you go. Don't give anybody the opportunity to shoot holes in this. Because on your balance sheet, it said that you had 100 acres of growing crops. I anticipate 50 bushels an acre, 5,000 bushels at $6.50 from our price list. That amounts to $32,500. All right, that's the crop side of things. Now I got my cattle. I got these steers. They're raised, 50 of them. I anticipate selling them for 750 pounds. You know, when they get that weight, they're going. At $1.35 a pound is the projected price on farm credit. Excuse me, FSA. That's $50,625. I got my heifers then, 40 of them. I anticipate selling them at 675 pounds, $1.35 a pound for a total of $36,450. I got 5 cull cows, so I'm going to keep 5 replacement heifers and cull 5 cows. They weigh $12.50 each at 70 cents a pound. That's a dollar value of $4,375. Okay, Now, this is the page that's missing in your 3-ring binder. I will email that to you, but I want to hit a couple high points here. I've got some government payments, some crop insurance money, some custom baling. So my projected gross income is $486,500. I have my expenses listed. Now, there's a few here that are, they're here. Interest is one key one at $40,000. But if you purchase cattle or hogs to feed and resell, you need to put those expenses here because there's no place for them on our forms. So our sample farm has gross income of $486,500, and we have expenses of $350,000. So when we get into session 3, I will have that information for you, and we will use that in our calculations. All right. That's our sample farm. Okay? Here I am. We're going to talk a couple things, and then we're pretty well done with this session, and we'll have a little wrap-up. We've got to talk about two things. One is land rent, and the other is 2013 projected crop income and expenses. I want to talk about land rent first. A little bit of history with land rent and land rental arrangements. Way back when, we used to have a lot of sharecropping, where it was either 2/3 or 60-40 or 50-50%. But the point is, in a sharecropping arrangement, the landowner and the person doing the farming shared in the risk of bushels and price. Well, as land rents increased and landowners got older, the spring of the year they wanted a fixed dollar amount for the cash rent. So many of those acres got shifted from a sharecrop arrangement to cash rent. Under a cash rent arrangement then, the risk was all on the shoulders of the person operating and managing and planting the crop and harvesting it. And it was a bushel risk and a price risk too. So what's coming then into South Dakota from Iowa is the flexible lease arrangements. And that's in your 3-ring binder. And the Appendix 3, which is way in back, page 8. No, excuse me, page A3 to A8. A is the appendix. You can read that over, but the basics of that is the landowner sets a minimum price for the land rent and a maximum, or what you would call a floor or a ceiling. You need to read this over and think about it. It shares the risk of bushels and price with the landowner and the operator of the ground. This was run off a few years ago in 2010. But if you want to do this calculation online, you can go to www.iastate.edu. Go under the Extension and Outreach. Type in Flexible Lease Arrangements. Scroll down and click on Flexible Lease Arrangement Workshop. Worksheet. And all this is there. It has some samples. But if you look at it, it walks you through who and what. Obviously, the yield is what you harvest. The price risk, determining the price. You take an elevator where the grain will be sold. by the landowner. And then you average a number of prices. In this example, it's the April and June price of the October delivery. And then December 1, the cash price, and you average those. And that's how the price is determined. The government payments all goes to the operator of the ground. The crop insurance is the responsibility of the operator of the ground. And then you have some of these worksheets, okay? And you can fill them out and go through it. And there are some examples.